You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to the Investor Way with me, Sam Ball. It's the 18th of August 2024, and I'm rejoined today by Andy, who goes by the Twitter or X username @FlyingFinance. So Andy is, for background, a pilot who came on the show, I think almost bang on a year ago, actually. It was August 23. So what I'm going to do is I'm going to release the previous episode as a bonus one prior to this. If you've not listened, I would recommend going back and listening to that first if you do want to find out a bit more about sort of Andy's philosophy and stuff like that. Or if you listen to this and enjoy it and want to go back and listen afterwards, that's fine as well. So Andy, firstly, thank you very much for coming back on the show. For anyone who hasn't listened to the previous episode, could you give us a very brief overview of sort of who you are and how you got into investing, and then also sort of what's changed in the past year, if anything at all, in terms of how you're managing your portfolio?
Yeah, sure. So first of all, thanks for having me back on the show. It's nice to be back on. I enjoyed myself last time, so hopefully I can provide something useful to people that listen today. So a bit about me, I manage my own SIP and also a small investment ISA, as well as some money for my daughter and my wife. I'm an amateur investor. My background is in real estate and business management. That's my academic background before I started flying. So even though I do quite like real estate as an investment, having spent 10 years working on building sites and doing property surveying, I wouldn't say it's a love of mine. So I have a holding in it because I think it's quite important to have some real estate exposure. But generally, most of my money is split between equities, some funds that I have for exposure to markets that I maybe don't know too much about, don't have the time or capacity to learn about. I've also got quite a lot of just low-cost ETFs just to provide a bit of balance to the portfolio. I don't want to be underperforming too much. So that just gives me quite a lot of exposure to US markets that I wouldn't necessarily put my own money in straight away. Provides me with a nice bit of diversification that I can just sit back and kind of leave to do its own thing. I'm quite a busy person, so it suits me to be quite a hands-off investor. So I try to limit the amount of time that I spend looking at stocks, and definitely the trusts and the REITs and a few other bits and pieces like ETFs that I hold definitely help me sleep at night whilst having exposure to those markets.
Have there been any sort of major changes? I'm assuming not, because it's only been a year, and I wouldn't imagine that much is going to change within a year. But have there been any sort of major changes or anything in the past 12 months?
No, I wouldn't say massive changes. And I think that's one of the important things of investing is that, you know, you shouldn't probably have any huge changes in philosophy or in your holdings in the space of a year. Definitely when we spoke on the last podcast, I talked about a book that I quite liked, which labels investors as rabbits or executioners. And I had definitely reached a point where there were a few holdings in my portfolio that were just sat there, not really doing a lot, not really sure what their purpose was anymore, and definitely not making me any money. So I feel I've been a bit more disciplined in the last 12 months, and definitely the interview I had for yourself was a bit of a catalyst for that, to force me really to clean up some of those little holdings, my portfolio, try and be a bit more focused, try and be a bit more bullish, where I look at stocks that I'm very keen on, not being afraid to have a slightly larger position in those. I still don't want a lot of exposure to any individual stock, but just having the confidence to put more money in, even when share prices are increasing. That's something I haven't really done before, averaging up. I've tried to be a bit more disciplined and a bit more strategic at that this last year. A couple of specific stocks. I had Hypnosis Song Fund, I think the full name was, last year. That obviously got a takeover target, so that's now gone. Royal Mail went the same way. Tritax Eurobox at the minute is in takeover talks, so that's likely to go soon. So I've lost a few smaller positions. I've added a couple here and there, but generally no seismic changes really in the last year.
So you mentioned that you've tried to average up more. Are there any stocks then that you have averaged up into in the past year, and what are the reasons for that?
Yeah, Associated British Foods I've definitely averaged up into. So that's the owner of Primark. I don't know if we're going to come on to that one later, but that's a fairly decent size holding for me within my SIP. And Supermarket Income REIT as well, which we may come on to later. It's another one where I've held it for about a year, 18 months now, and I've just every update has been exactly as expected, really. So it's given me the confidence to put more money into it. It gets easier the longer you hold a company. Once you've owned a company for a few years and you've seen the updates coming through and there's no surprises up or down, I find it much easier to put a larger sum of money in than initially. Some people are very good at putting in large positions straight away. I much prefer slowly dipping my toes in and averaging up from there just to try and reduce the risk and the uncertainty.
Well, I think we may as well just dive straight into Primark in that case, or
Yeah, sure.
ABF, seeing as you brought it up. So do you want to give us an update on that then, and why you do still like it so much, and why you like it so much that you have added to it? And also, you did talk about the American expansion last time you were on the show. So if you could just give us an update on that too.
Yeah, of course. I'll probably refer to it as both Associated British Foods and Primark, but ultimately the company is Associated British Foods, who happen to own Primark, but it's a fairly substantial chunk of the business. When you do buy ABF shares, you do also get the British food side, which includes quite a lot of household names of products that you're likely to buy, and Tesco's. They're quite good brands actually, and you get quite a decent selection. It's quite well vertically integrated, both products for us and also products for animals as well. There's animal feed in there and pet food goes in there as well. So it's quite a nice diversified company. I bought it first about 18 months ago, maybe 2 years ago, just coming out of COVID. Like all high street retail, it had been pretty beaten up during COVID as they weren't allowed to open. And then coming out of COVID, it just seemed like a very attractive price for a diversified business that is pretty unique really in the UK. You're getting quite a nice mix of food products, and also you're getting Primark on top of that. That's really appealing to me, having that diversification in one company. It's also got a large family ownership from the original family that set up Associated British Foods, and it's multi-generational directorship. So there's a lot of strong governance going on there. These are people that have inherited the business from their parents and grandparents. They are not the sort of people that are going to trash and burn the company and drive it into the ground, you would hope. So that was what really appealed to me. The last review I did of that was back in February 2023. You can find that on my Twitter if anyone is interested. And that was really around the next phase of their growth, which is going into the USA. I have relatives out in the US. Whenever they come to London, one of the things they want to do is go to Primark. Now it's hopefully up in the US, a huge market for out there. When we spoke last time, they had 15 US stores and there were 9 due to open from that point. That was 18 months ago. They've actually got to 27 now, so they've opened a few more than the 9 they'd previously announced, and there are 4 more on the website listed, so that'll take them up to 31. Their target is for 60 stores by 2026. At the current rollout rate, they may be a little bit behind on that, but one thing I do quite like with Primark is you can go onto their website and look at the careers page, and they have all these listings for store managers for new stores, so you do get a fairly good idea of both the numbers of stores they're opening and also the geographical spread of them. So one thing we talked about before is how they're expanding more and more out of the East Coast of America. In the next few months, they're looking at opening stores in Texas, Tennessee, and Maryland, so a little bit away from their traditional footing of New York and Boston, where their main base is before. And it's actually grown to the point now that only 44% of Primark stores by quantity are based in the UK. I think we generally like to think of Primark as being a British company because we see it all the time. But as it stands right now, nearly 2/3 of their stores are actually overseas. They've got quite a lot of exposure in Eastern Europe, Central Europe. They are rapidly rolling that out. I think in terms of comparators, the closest one for me really is Next. I don't doubt for a second that Next is a very high quality business, but it is a little bit dearer than Associated British Foods. Next at the minute it's on a forward PE of 15, and you're getting ABF for around 12. It's got slightly better yield with ABF, 2.9 versus 2.4%. But for me, really, it's the PEG ratio that's most interesting. This is all Stockopedia data. Next, have got a PEG ratio at the minute forecast of 16, and ABF have got 1.8. So it seems to me like the forecast for Next, maybe the next year or two, is not for big growth, but there's still a bit of growth left in Primark. It's definitely not cheap for the growth, but it seems fairly valued to me. I really like the fact they seem to be executing in America and they seem to be delivering on that, and that's really my thesis for investing. So for me, it's maybe a 5 to 10 year investment. Hopefully that'll roll out, and it wouldn't surprise me at some point if the Primark brand got split off into its own entity, because it seems a bit of an awkward fit within the bigger ABF group now, maybe.
Why do the American relatives want to go to Primark so much? I wouldn't necessarily have expected that.
Yeah, it's a bit weird. Certainly when you go to Oxford Street in London, the first thing when you walk into a branch of Primark, the first thing they often have in front of the door is suitcases. And this is maybe going back 5 or 6 years a bit, but definitely there are a lot of Polish speakers and Eastern Europeans would arrive in London, would buy a suitcase and fill it in Primark. I just think the value that they have on offer, and ultimately they are still trading as a bit of a British-Irish brand, and there is a little bit of, a bit of attractiveness to that to overseas nationals. People just like the range of products they have. They like the pricing. Obviously, that's the main reason most people go into Primark. And I think we forget in the UK, before we had a lot of companies like H&M and like Primark, just how expensive the high street was. And it's really these low-cost retailers who've driven down the prices. But that doesn't exist in every market. So the fact that you can go into Primark now and buy a t-shirt for, I don't even know nowadays, £3 or £4, it's just unbelievable for a lot of markets internationally. I think that's fairly unique. I definitely think people notice that when they see it and do definitely remember the brands.
I just would have thought if someone's coming from the US, you kind of assume they've got an equivalent. Do you not think they have based on that?
They kind of do. I did live in the US for a little while. They don't have anything like I'd say is directly comparable to Primark. You know, you have Walmart is quite heavy on clothes retail
That
out
would be
there.
like Asda and George, though, wouldn't it?
Yeah, exactly. When you go into a Walmart, I would guess that probably 40, maybe even 50% of the floor space is non-food items, which is quite different to a lot of UK supermarkets where it might be kind of 10 to 20% is non-food. In the US, it is huge. Like half the shop will be sports gear, clothing, just random items that you get in their homewares and stuff like that. It's a much bigger deal in America. I also think there's like a little bit of insulation here from online retail. Clothes are still one of those things that the online retailers have struggled with a little bit. And specifically talk about ASOS and Boohoo. You've got the rise of people like Shein from the Far East coming in, but I think the plan is at the minute that VAT will be applied on those transactions pretty soon. So I would have said a year or so ago that'd been quite a large threat to a company like ABF, but it looks like that playing field might be leveled a bit more in the near future. So yeah, I'm generally quite positive on them.
So what's Shein? I haven't actually come across
Oh,
that.
Shein. It's a bit like Temu. It's like one of these apps, a bit like Alibaba and AliExpress, but more for clothes and fashion and jewelry and the like. So it's a website you can go on via the app and you can order clothes for like $1 or $2 delivered to the UK. And it's obviously clearly undercut by the fact that there's not much duty paid on any of the clothes, but the rumings are that the budget later this year might address that issue.
Why do you think the forward PE is so cheap then at 12 if it's bombing away like that? I mean, I know it's always traditionally been a very cheap business. Do you think the diversification maybe goes against it in that compared to, for example, if it was split out, it might have a higher multiple? But I'm just wondering as well in terms of that forward PE, do you think it's because they have traditionally taken their time with the US rollout?
Yeah, I think it could be a bit of that. I definitely think that diversification's maybe working against them. Like, I personally quite like it, but you don't hear many people saying, I'd love to buy Next shares, but I wish they had like a dog food company on the side of it, or I wish they were also selling like curry sauce in the supermarkets. Like no one ever wants that sort of diversification. It's a nice to have, but it's not really strategically helping the business that much from what I can tell. It's just de-risking it a little bit. So I definitely think that's holding it back a little bit. I think there's an element that almost all UK retailers are on quite low PEs at the minute. Next is maybe the exception, but even Next isn't on a sky high PE really, and that is viewed as like the epitome of quality retailers in the UK, I would say. I think they all trade on quite low multiples really, and maybe ABF is just a little bit lower because it's a bit more watered down, for want of a better word.
So if we move on to the REITs then, so you mentioned you've got the supermarket REIT and Tritax Eurobox / Big Box. What's the difference between what's Tritax Euro? I'm assuming there's some link between Eurobox and Big Box, but I've only ever traditionally followed Tritax Big Box. So what is the difference and why do you like those two?
That's a good question. So they're both managed by the same company. I can't remember who it is offhand. They're not called Tritax, the parent company that actually manage them have a different name. But basically, Tritax Big Box is UK only kind of warehousing and logistics. Tritax Eurobox is European only. So they have quite big distribution hubs in, from memory, Amsterdam, Madrid, Barcelona. I think there's some around Maastricht maybe, but it's European focused only. Eurobox trades on two different tickers. You've got Box E and E-Box, depending on whether you want it euro or British pound denominated. I can't remember offhand which one is which. The reason for holding both really, looking at the planning regulations in Europe, it's quite difficult to get planning on these big warehouses. There's certain sites have quite a lot on, but a lot of these companies were struggling with getting planning consent on new sites, far more so than they were in the UK anecdotally. So the Eurobox play was mostly that the value of those assets was likely to increase more than maybe the British assets. I was buying these not long after Brexit. And also, again, a bit of geographical diversification into markets that I wouldn't normally get diversification into. Both of those, when I bought them, were trading at decent discounts to NAV. Eurobox has had a takeover approach probably about 3 months ago, so the discount has narrowed quite a lot. And also Tritax Big Box, which I think you covered on last week's show, that has closed the gap somewhat as a result of that takeover with Tritax Eurobox. But that's effectively the difference. One's British, one's European, and they focus on those markets entirely separately.
Have you thought about selling Eurobox then if it's had an offer and the gap's closed? Because normally REITs do tend to trade below the net asset value. So if it's now, is the gap narrowed but it's still at a discount, or is it now trading much closer to the value of the net assets?
Yeah, I think it's still at a bit of a discount. I have to pull up the details here. Yeah, to be honest, it is probably one in the next week or two I will get rid of. It's still at a discount of 16.5% actually, so it still has got a bit of discount in there. I can't remember offhand what the bid price was like relative to the current share price, but I don't expect there to be a huge amount of upside potential from now if the takeover does go through. So it might be one where I'm probably better off taking my money and reinvesting it into another REIT. I've got a couple others I can talk about if you want to talk about some REITs.
Yeah, sure. Have the REITs been bulked up since last year then?
Yes.
In general?
Yeah.
And what's the logic behind that?
There's a few bits. So if people want to read a bit more, I put a Twitter post up on the 14th of February. So if you go back through my Twitter, you can see a little bit of the rationale behind that. There's two reasons for it, really. The dividend on offer on some of these is very, very, very good indeed at the minute. And there's also some very good discounts to be had. So in the case of Eurobox, that's closed up a fair bit. But there's still some REITs out there on fantastic discounts and REITs on very reliable, safe, high dividend yields. So really, again, it was to provide a bit of bulk in my own portfolio. So a couple of weeks ago when there was a large drawdown in shares, I was quite happy that my portfolio didn't go down as much as the overall FTSE. It does mean on the good days when the FTSE goes up, I don't get all the gains as well. But I do like the fact I've got some asset-backed holdings that provide me with a nice, reliable dividend going on into the future.
So what do you like about the other ones then? If we go, so in particular, for example, supermarket REIT, what do you find so attractive about that? How did you pick these REITs just out of all the REITs that are available? Because there are obviously absolutely loads. So how did you go about deciding which ones you wanted?
Yeah, so there's a really good resource that many of your listeners will know about, the AIC, so THEAIC.co.uk, the Association of Investment Companies. That is, it's a really, really good website. You can filter through loads and loads of different trusts and REITs. It's not just real estate stuff, it's all sorts in there. You can filter it by discount, by market cap, all sorts of really good data. So if anyone's looking for REITs, that's a very good place to start looking, have a look at what's available and to see what's out there. To go back to your question, how I found those two, I did use the AIC website for that. Really, I was looking for stuff on a discount. I was looking for stuff with decent yields. I was looking just for exposure to markets that I viewed as being a bit safer. So I don't generally have any REITs. In fact, I don't have any REITs at all in high street retail or office space. My REIT exposures are all a bit more specialist than that. That can be beneficial. That sometimes can be to detriment because you are quite specialized there. And if a sector falls out of favor, it can be a bit negative. But maybe if I explain on supermarket REIT what my logic is there, and I've just increased my position on that this week actually, because I was doing a bit of prep for the show and reading through it again and thinking it's actually a very good opportunity there at the minute. So for anyone listening doesn't know, Supermarket Income REIT, they own supermarket sites. They've got 73 different stores, predominantly in the UK, but about a dozen or so in France as well. They rent their stores out to Tesco, Sainsbury's, Waitrose, Morrison's, Asda, M&S and Aldi. So you've got a huge diversification there in customers as well as geographical areas. They listed on the stock market in 2017, and one thing I really like about Supermarket Income REIT is how reliable they are. So they have had 100% occupancy since 2017 and 100% rent collection since 2017. I haven't gone through and compared that to every REIT in the market, but I'd be amazed if there were more than a handful that could boast the same. They've also increased their dividend every single year since they listed. So you're currently getting an 8.2% dividend yield on that. They've got long leases, so the customers are very, very unlikely to move out. And also, if you go on the AIC, you can pull up a little graph of how their discount to NAV has been over the last 6 or 7 years since they listed. If you go back pre-COVID, there's only one time you could ever have purchased this at a discount, and that was about a week or two after they floated. They had a discount for about a week and then went to a premium. During COVID, again, there was a couple of weeks where you could have got it at a slight discount and then it shot back up again. And really, it was at a premium all the way through to late 2022 when interest rates really started to bite. And that's what's brought the share price down on this a lot. So from premiums of kind of 10 to 20%, you can currently get this one at a discount of 15% to NAV. I just really like the company. I think they've got great tenants. They collect their rent on time. They've had 100% occupancy. The fact you can get this at a discount of an 8% yield to me is unbelievable. So that's why I've been topping this one up.
It's rare we cover a REIT on the show, in fairness, but I don't recall ever covering one with 100% occupancy and rent collection in any year, let alone since 2017 or whenever it was.
It's very impressive. And I think the other thing with supermarket REIT that draws me to it over other REITs is if you've got a high street residential store and it's listed in a REIT and the tenant moves out, you really only have one use for that property. It has to be leased to a high street retailer of some description. The difference with the supermarkets is they own prime real estate with good infrastructure links, generally near populations of people, unlike warehouses. So the opportunity, if like near me, there's a home-based store closed down recently, that's getting converted into apartments now, and it basically overnight it would be starting work on apartments. You've got quite a unique real estate asset in that it can be flipped to a different purpose very easily, be it light commercial, different types of retail, residential. To me, that's quite a good insurance policy versus some of the retail REITs and some of the office REITs, which are a bit more limited in what they can actually do with the properties.
So I did another interview earlier today with a guy who he actually referred to your interview last year when he was doing it, but he also mentioned supermarket REIT and why he liked that. So it might be a sign that I need to take a look at that.
It just ticks so many boxes for me. The big retailers do have a lot of power over the people that supply them, and that would include supermarket income REIT to negotiate rents down. But I think the number, let me have a look. 78% of supermarket income REITs rents are inflation linked. So you've got a lot of protection from that. And also I think a lot of these companies like Asda's gone to private equity recently. Tesco's have been trying to reduce the amount of property on their balance sheets, doing sale and lease back. I think there's quite a big opportunity for companies like supermarket REITs to carry on growing and take on more assets as supermarkets sell them off effectively.
I think Morrison's as well, that delisted. I know we're going back a few years, but so you forget about it. But I think Morrison's as well. That's probably another one. You've also added a position in Coca-Cola Hellenic Bottling Company, which neither me nor John own, but it is a favourite of the show. So could you just tell us why you do like that?
Yeah, I first came across it about 5 or so years ago, maybe 6 years ago, and kind of brushed it aside and didn't really do any serious investigation on it. And it's one of those shares that when you start researching it and you start learning a bit more about it, I just find it a fascinating business. As the name would suggest, it was originally the Greek bottling arm of Coca-Cola. It now covers quite a big geographical area, so we touched on it with a couple of the other holdings. That's a big appeal to me. It's mostly kind of the Balkan countries and Eastern European countries. But the more research you do on this, the more you realise it's quite diversified in terms of its product portfolio. So they obviously distribute Coca-Cola and the variants of that, Fanta, Sprite, Schweppes, and Vitamin Water, which are all Coca-Cola branded stuff. They're doing more and more of the Costa branded coffees, including like the iced drinks that you get in cool aisles at supermarkets. They also do a lot of bottled water in that part of the world. They've got 23 different brands of bottled water. What's interesting for me on this one is more the slight tilt, for want of a better word, into the premium spirits. So he had a bit of a deal, it seems, with Brown-Forman at one point from the US, distributing a lot of their spirits. So Jack Daniels is one of their brands they distribute in Eastern Europe. But then you've also got things like Macallan, Aperol, Grand Marnier, Woodford Reserve, Campari. But the one that's really quite interesting for me is Finlandia, the vodka. I don't hold it out as a particularly brilliant brand, but what's quite unusual about that one was that it was owned by Brown-Forman, and now the brand itself is owned by Coca-Cola Hellenic. And I just suspect that that's maybe a bit of a pivot towards where they're heading in terms of actually owning these brands rather than just bottling them under license and distributing them. They're quite a cash-rich company. From memory, they've got about 2 or 3 billion euros on the balance sheet. They do pay a bit of a dividend, but they're not paying out huge dividends given the amount of cash they've got. And I've been watching recently a few videos of some of the directors of Coca-Cola Hellenic, and they're all quite young, driven, motivated people. They don't strike me as the sort of people that are happy just bottling Coca-Cola and shipping it to stores around Europe. They all strike me as people who want to grow this business and get it moving somewhere. I'm not entirely sure what direction that is or how it looks, But at the minute, it's on a forward P of about 13 and it's yielding 3.3%. It seems like quite a safe brand to me, really. It's quarter owned by Coca-Cola in the US, so it's going to be distributing in its areas for the foreseeable future. And I just feel like if they're going to restaurants and bars with bottled water and Coca-Cola and the like, the add-on of selling bottles of Jack Daniels or bottles of Finlandia vodka is very easy for them to do. The cost of them delivering on that on top is basically zero if they're going to that store anyway. So they have a big opportunity to upsell some of these products. And obviously the margins on a bottle of whiskey or a bottle of vodka versus a bottle of water, it must be huge in comparison. So it just interests me that it's still a relatively cheap business. I wouldn't call it value, but it's definitely kind of in the growth at a reasonable price camp for me. And it just feels like it might be on the precipice of doing something a little bit more interesting over the next few years, trying to increase margins and trying to grow sales a bit further. That's the gut feel I have with Coca-Cola Hellenic.
Yeah, it's one that we both like. I hadn't actually appreciated. I'd seen Finlandia in there in the last results. I hadn't appreciated they owned it outright, actually.
It was about 3 months ago, maybe, if memory serves me correctly. And I did a bit of
we did
digging.
cover the last results sort of 2 or 3 weeks ago, though, and I just
Yeah.
hadn't picked that point up. To be honest, I think we were a bit distracted by how well the coffee was doing. So I just don't think we got into that level of detail because I don't think we really appreciated. We just didn't appreciate that.
Yeah, and I think it was. I'm pretty sure it was bought off Brown-Forman, the US drinks giant. And if you go on the Brown-Forman website, Finlandia is no longer on there. So I don't know if it's a European-only brand or whether it's ever sold in the US, but it certainly appears that Coca-Cola Hellenic own it outright now and are distributing it on their own in those patches. Definitely have to do a bit more digging to see who owns it in, say, the UK and France and Germany, but it definitely seems like a step in the right direction for them.
It's not huge, but they did buy the rights to the Egypt business, I think, in the last year or so. And then I think one of the things that we like about it is obviously like I think it was one of them companies where like we just kind of discounted it because you think, well, they're just doing the bottling for Coca-Cola. Coca-Cola feels pretty saturated, and then we only, I think, started covering it sort of maybe like a year or so into doing the show.
Yeah.
And you cover it, and I think not too long after we started covering it, Russia invades Ukraine, and basically 2 of those markets that they have are just kind of wiped out almost
Yeah.
overnight. But then if you look at the results now, it's almost like they've got to a position where that hasn't happened. It's like as if it never happened. It's kind of recovered to where it was. And I think they've done a really good job with that. And obviously, if that does switch back on at some point, then obviously that's great. But if not, I think it just shows sort of how well run the business is that they've been able to deal with that. Because it was like, I mean, when Russia invaded Ukraine, I think sort of Coca-Cola Hellenic lost like 20-25% of its market cap, within that next week. And it's just fully recovered now. And I think it does just show what a well-run business it is. And I think as well, I know we talk about it every time we cover it, but I think what we like about it as well, it's obviously you've got the safety of that Coca-Cola brand, but
Yeah.
it's basically a pure play on emerging markets, but in what I would consider quite a safe way. Because you go over, I mean, you'll obviously do it more than me as a pilot, but you go over to these countries. Like I was in the Balkans a few months ago. I can't remember which ones I was in. I was in Montenegro, Bosnia, and Serbia. And again, it's Coca-Cola is just everywhere, and a Pepsi is too. But it's not. They're obviously pretty saturated there as well. But yeah, you've got that emerging markets play, but with that safety of the Coca-Cola brand, which I really like. But yeah, I agree. If they could start getting into alcohol as well, that would just be even better.
Yeah, and I think like there's some interesting stuff in terms of the demographics and the economics of the countries that they're providing their drinks to. So my wife is from that part of the world, and when you go down to Croatia, and I've been going there for probably 10, 12 years now regularly. Back in the day, you used to be able to sit on the beach and have a beer for about €1 or €2. And now you go down there and it is in the summer not far off the price I pay for a beer here in London. In the space of a decade, it's got a lot more affluent tourists visiting, and the people that live down there have more money than they did before. So Croatia's just joined Schengen this year. I think it just joined the Euro this year. Those countries are developing quickly. I don't know if Coca-Cola have Albania on their distribution, but that's another country that's changing very rapidly. So you've got a lot of countries down there that are getting a lot wealthier, getting more tourism coming in, and it just seems to all be pointing the right direction really for a company like Coca-Cola down there. And as you say, like Coke's pretty saturated, but Coca-Cola in America is on a P of 28 at the minute. So Coca-Cola Hellenic, you're getting basically half price. I know they don't have the rights to Coca-Cola in quite the same way as the parent company do, but even still, that's a hell of a discount for a company that I suspect might grow just as well as Coca-Cola over the next few years.
Well, I think as well it's half price, but I would argue, a more attractive market because you've got those demographics working for you in a way that I just don't think you do in America. I don't see Coca-Cola gaining market share in America in the next 10 years. I think it's more about preserving what they've got, which in
Yeah.
fact they've done a fantastic job at. So you've got a new position in M&G, which isn't necessarily one that I would have expected. So what's the logic behind that?
Yeah, so it's not one I'm going to be able to talk about at huge length, just because it's one I haven't done as much research on as I would ultimately have liked. Essentially, when interest rates started going up a couple of years ago, like a lot of people, saw it as an opportunity for banking and finance in the UK to do quite well out of it. I personally find it a really boring, really dry, almost intolerably dull sector to research. So I've got quite a bit of Polar Capital Financial Trust. I honestly just think with some of these industries where if I try and do research on it, I'm just going to give up basically. So it's far easier for me to pay a couple of percent for someone like Polar Capital and they're people who are specialist banking analysts to do a lot of the research for me. But I do make a bit of an exception to that rule when I find companies that are more or less household names that are going through a bit of a turnaround, that have decent dividend yields. So really with M&G, that's the main appeal for me. The dividend yield at the minute, let me just pull up the data, is fantastic. I think it's about 7 or 8% from memory, 9.6% forward dividend yield. They just had a new director come in a couple of years ago who's got a good background in investment banking and finance. He's brought in what looks to be a pretty good leadership team. It just feels to me like a bit of a boring old company that maybe needed shaking up a little bit. It's very cheap. When I bought that, I think the price earnings was about 7. It's about 8.7 now for something that's yielding nearly 10%, that's going for a bit of a transitional period where profits could grow. As I say, I haven't put huge amounts of research time into it, but it's got a fairly well covered dividend and it's cheap. So I don't really need to do masses of research on it. I'm fairly comfortable. It's not going to go down much more. Looking at the share price over the last 6 months or so, it's been down to just under £2 and it's at £2.10 at the minute. So it's in a bit of a range, but I think a 9.7% dividend yield for a fairly reliable, boring company is something that can't be missed, really.
You've also got a physical gold position, which again, I wouldn't have predicted if you'd made me guess some of these new positions in advance. So what's the
Yeah,
logic behind that?
that's basically all on technical reasons. So the gold price has been hitting all-time highs the last month or so, which is quite a bullish signal. So when it hit an all-time high about 2 or 3 months ago, I started a small gold position, not a large position at all. Within my SIP, it's probably, I don't know, 3 or 4% maybe maximum. There's quite a lot of catalysts. I know it's a bit of a cliche that gets rolled out every year or two, but it does feel like we're living in quite an unstable time at the minute with wars in the Middle East and Ukraine at the minute, and just generally quite a lot of uncertainty. America potentially heading into a bit of a recession, China maybe ramping up tensions. Who knows if we're going to get Trump in? It just felt to me like having a small amount of gold tucked away didn't seem like a bad option at the current moment. I think I'm up about 4 or 5% on it so far. As I say, just a small position, but just enough to have a toe in the market. My plan with that really is probably just to hold the gold holding, maybe top it up here and there. But my plan for next month or so is really to research some of the gold miners. Obviously, with the gold miners, you've got a leverage play on the gold price. They've been hit quite hard over the last couple of years. So even though the gold price is at all-time highs or within 1% or 2 at the minute, a lot of the gold miners are well down on where they were a year or 2 ago, which is quite illogical. But a lot of them have been hit by adverse weather and also quite high energy costs, meaning that their cost of extracting gold has gone up. But I can see there be a situation in a couple of years' time when those gold miners might come back into favour with the high gold price, and if their costs start falling, that leverage could really pull through quite nicely to some quite good profits. So it's something I'm looking at a bit more maybe is either buying a few cheap gold miners that are in safe parts of the world, or there's quite a lot of ETFs in gold miners or junior gold miners that you can get just to get some exposure to that leverage if the gold price does stay high for a longer period.
The miners not concern you a little bit though, in that if the results are poor, I know you sort of mentioned factors like weather and energy costs, but we're talking about gold prices at all-time highs, which in theory should be at the towards the top of the cycle, or are you basically banking kind of like with the gold, this longer term it's going to go up? And I do appreciate the gold price, although it's at an all-time high, it's a number of years since it previously set an all-time high.
It was, yeah.
So is that the reason behind it? You think it's still got a way to go, the gold price, so you're not concerned that the miners are maybe not at the top of the cycle?
Yeah, I definitely still think it's got a way to go. I also think that the Indian stock market's done quite well over the last 5 or so years. I've been to a few of my mates' weddings who are Indian. The amount of gold you see at Indian weddings is just unbelievable. And if that stock market's performing well, and from all the people I know that live in India or British Indians, the Indian stock market seems to be performing very well. I suspect demand for gold jewelry will be going up from this point. It definitely doesn't seem like one of those things that falls out of favor, unlike diamonds and the like. We've got synthetic diamonds that are effectively stealing that market in its entirety at the minute. So I do quite like gold. I think I generally, when I'm doing research of shares, it's mostly to cultivate a nice little watch list, so that, like with Coca-Cola, I'd had it on my watch list probably 2 or 3 years before I bought the shares, just trying to time that purchase when it works. And if it doesn't ever work, it's not the end of the world, but it'd be quite nice, I think, to have a couple of gold miners that I know, if energy prices start dropping and if their share prices start creeping up, there could be a good investment to try and capitalize on that. So yeah, I'm no expert on commodities. I'm no expert on any of this, to be perfectly honest, but certainly on commodities, it's a bit of a dark art. But it does feel like a lot of these mining companies have stripped back exploration for the last 10 years or so, and now we're at a point where demand is outstripping supply, and they can't create that new demand quickly enough, really. So it'd be interesting to see with the gold price so high, whether it does pull some of these miners up. There's quite a lot trading at quite good valuations at the minute.
I know I will have asked you this a year ago, but I just wonder if you're delving into gold might have changed the position. But have you considered having a Bitcoin position for similar reasons, or would you still discount it? And also, I appreciate you can't have it inside a STIP.
Yeah, I did actually open up is it Coinbase? I think I've got the Bitcoin account, and I kind of chucked 20 or 30 quid in just to see how it went. And I literally timed it to the day of the all-time highs of it, and then it came off since then. So I haven't really looked at it in any great detail. I'm a bit skeptical of it. I don't fully understand it. I find a lot of the people that, when you go on YouTube and you look at Bitcoin stuff, I find that the whole product, for want of a better word, it's just a bit confusing. And yeah, I've considered it. I've bought a few, but it's not for me for a large chunk of my portfolio. Although, can I ask you one question on that?
Yeah, sure.
So I seem to remember probably about 6 months ago on the podcast, you talked about getting a position in Dogecoin, was it?
Yes.
So I have not looked at the price of Dogecoin, but how has that panned out so far? Has that been working?
So initially it worked. So it was only I put a small amount in, as I explained at the time, with the logic that you get after the block reward halves for Bitcoin every 4 years, you tend to get in the next sort of 6 to 12 months quite a large price run up, a new all-time high reached, and you tend to find that the other coins will run up along with Bitcoin, and they will actually usually run up even more. The issue is that when they go down a lot more. So where
Yeah.
Bitcoin might go down 75% in a cycle, Dogecoin might go down 90, 95, 99% in a cycle. So if you don't get the timing right, it's pretty horrific. Because obviously if you buy it 90% down and it goes down to 99%, you still lose 90% of your money. So that was my logic. And it's difficult as well, because the problem is with a lot of these altcoins, although they will go up exponentially compared to Bitcoin, the problem is it's not always the same ones in each cycle. So it's like if you go back and look at the ones that did well in the 2017 bull run, a lot of those ones no one's really interested in now, and it's sort of different ones. So again, it's quite hard to identify ones that have done it for multiple cycles, and one of the few that has is Doge, like I explained on the podcast, and you obviously had Elon Musk sort of pumping it up as well. So I think I initially bought in, I want to say about 13 cents a Dogecoin. It then dropped down to about 10 after like a month, or maybe a bit longer actually, after a couple of months. We dropped all the way down to 8, but I think I added it at about 10 cents. And then it ran up to, oh no, maybe it only drop down to about 10. But anyway, I think I got fairly lucky with when I topped it up. And then it ran up to sort of, I want to say like 17, 18. So I was up kind of between 40 and 80% on my position, depending on sort of the two lots I bought. It's then since run down quite a bit. So it's now at 10. So I think I am actually down on it now slightly. And the issue I've got is obviously the longer this goes on, the more likely it is that I am wrong. Because the halving was in April. So I kind of would have expected by now that it'd be bouncing. But I'm probably going to hold it. I don't know. I think I'd probably hold it for like another sort of 6 to 12 months and just see what happens. But my logic is that I've put enough in. I've put such a small amount in that, if it goes down to 0, I'm pretty comfortable with it. And also the money that I've done so well on the Bitcoin that I kind of view it as almost like using some of the Bitcoin profits, which I sort of view as free money. I know it isn't, but the Bitcoin, although it's down from its high, it's still doing very, very well. So I'm not too concerned. But if you were to go and look at the chart of Dogecoin over the last 10 years, when it has these exponential rises, it can be down for like 2, 3, 4 years and then rise exponentially in literally a couple of weeks.
Yeah.
And if you're not in for that window, that's it. So that also makes me a bit anxious to sell it, because it's like if my timeline is 6 to 12 months after April, if I don't get that timing bang on, you could literally sell it, and 2 weeks later it's like tripled. That's the thing with it. So I'm just viewing it as a bit of fun money, and I'm hoping it will still come good. But at the minute I'm maybe down sort of, it's not lows, because I bought in at 13 cents and I think sort of 10 cents or something like that, and that's around where it's at 10 now. So I'm maybe down 15% overall. So I'm not too concerned. Whereas this, someone who bought it at 80 cents, it's obviously down a lot more. So, but it could drop further. But yeah, at the minute it's not doing very well, if I'm being totally honest.
No, I remember vividly where I was listening to that podcast driving to work and thinking that's absolutely genius. Like, as
it would have been if it worked.
Well, yeah, but I remember you discussing like the upside and downside potential and thinking, yeah, he's not wrong. There is a big upside potential if it does follow Bitcoin
I think that's
up,
risk
and if it
reward
doesn't, there's not much. Yeah,
yeah, because it's a little bit of money. I can't lose more than 100%, and I think if I get this right, I think it sort of triples or quadruples. It possibly goes even higher, because I mean, it would actually have to it would have to 7 or 8x just to get to the previous all-time high. If it was to surpass that, you're sort of looking at 10 or 20x. And I just think, well, say it tripled or quadrupled and I sold out, what are the odds of it going to zero? And I think the odds of it going to zero without doing this one more time, when you look at the number of times it's done it, I know it's not the best logic, but if you want something to like triple, I know we want everything to triple, but my logic is kind of, well, the odds of it going to zero need to be better than a third to justify the risk.
Yeah.
So that then if you were to sort of, basically, if you were to do this sort of randomly 100 times, you need it to work enough that you were up overall, rather than it just being kind of one gamble where it's just a freak event and it's like, well, maybe you've 100 extra money, but it was a 1 in 1,000 event. So even though you got really lucky on it, you've actually made a stupid decision. That's kind of my logic with it. And I know it is still obviously stupid, but I just think the odds of it going up exponentially, I think, are actually pretty reasonable. I think there's a fairly reasonable chance of it, given it has done it so many times historically, and you've got all these sort of historical events that seem to be in its favor. So I just think, for a bit of fun money, I think it's kind of worth a punt. But I do emphasize, it's like, I'm entirely comfortable with it going down to zero. And that is a strong possibility, even if I think the risk reward is disproportionate. So yeah, we'll see with that. But yeah, hopefully it'll still come good. But by then, Labour might have increased its capital gains tax more. So that's the other issue I've got with it, because it's not in an ISA or anything, and because that annual exemption is only 3K now, you can very quickly get a chunky tax bill on it.
It's lucky you're a specialist in that.
Well, yeah, and it's it'd be a nice problem to have when you're down 15%. If I could get a chunky tax bill, I'd take that.
Yeah.
Is that all of the new positions? So you mentioned as well, you're looking at Diageo and JD Sports as potential purchases. Can we talk about Diageo first? Because that's one that we both, well, John owns it, but it's one that we both like quite a lot and have covered quite a lot on the show.
Yeah. I've listened to your updates on it regularly, and that's one that's definitely been on my watch list for about 3 or 4 years. I kind of missed out on it about 2017, 2018 when it had good run up, and in some ways it's a bit gutted I missed out on that, but in other ways it's now well down. Honestly, this one's on my watch list and I'm ready to buy it tomorrow if a couple of things happen to it. So I'll tell you a little story first. I was on holiday a couple of weeks ago in South America, and I was sat on the beach, and the barman came over to us and took our drinks order and walked off, and down the back of his leg he had like the Johnny Walker guy tattooed, probably like 2 foot tall down the back of his legs. And it got me thinking that, like, I'm like 4,000 miles from home on the beach, and there's a guy that's got a tattoo of a brand owned by a FTSE 100 company. And it got me thinking, like, how many brands are there on the FTSE that you can buy that have that sort of recognition and that sort of popularity, that you'd have a tattoo like that done all down your back? And
you're not going to get a NatWest logo, are you?
You're not, are you? It's not going to happen, no. So that was kind of a bit of a moment for me, that I was like, this is an exceptional company. But at the minute, it feels to me like the timing's maybe a little bit off. So There's a couple other things I quite like about it. It's got a bit of a moat that a lot of people don't talk about in terms of the whiskies and aged drinks that it produces. So if you want to produce a whiskey to compete with Johnnie Walker Black Label, it's probably got to be in a barrel for a decade. So that means that unless you are putting that in barrels right this second, you are probably not really a competitive threat to Johnnie Walker and Diageo until like the mid 2030s. That is an incredible moat it's got, really. And some of their whiskies obviously in barrels much longer than that. The brand recognition is just next to none. You know, you go to almost any bar in the world, they'll have Johnnie Walker. Any pub will pretty much have Guinness anywhere in Europe, the Far East, even lots of Africa drink that stuff. And they've also started, I don't know if you've been to Edinburgh recently, but they've got the Johnnie Walker experience there, which is a bit like the Guinness Storehouse in Dublin. You can kind of walk around, you can sample some whiskies, you can
Have you
have
done
this
it?
sales pitch. I haven't actually, even though I've been to Edinburgh twice this month, I've not
Yeah,
had
it's
time
because
to go in.
I've been a few times in the past sort of 12 or 18 months. I've probably been like 2 or 3 times. And I've done Dublin recently, and I did the Guinness Storehouse then and really enjoyed it. So if
It's
it's a
very good, isn't it?
comparable kind of experience, I would love to do it actually.
Yeah. But I looked on Google, that's got a 4.7 rating, which is not easy to achieve. It only opened in 2020, 2021, something like that. So for a relatively new attraction to have a 4.7 rating, I thought that was pretty impressive, really. Yeah, so it's got that going for it. There's a couple of things that hold me back from buying at this moment. Again, we talked about in the last podcast, I like to see shares that are trading above their moving averages. So generally, if it's not above a 50-day moving average, I don't really want to take a starter position even. And unless it's above a 200-day moving average, I don't want to take a full size position. So at the minute, I think it's nudged up towards 50 in the last week, but it's still 10, 15% below the 200-day moving average. So I'm just waiting a little bit longer on that. Also, the analyst expectations on it have been cut back quite a lot over the last year. So I think they went from about £2.50 to about £1.80 over the last year. So my fear is, even though the PE now is like south of 20, which is quite rare for a quality company like Diageo, I think the forward is 17 or so. If the analysts keep cutting the expectations and Diageo don't prove them wrong, that to me means that the share price could come down further. I think the final thing I'm looking for is like a little bit of director buying. I look through on Stockopedia the last 5 years of records, and their CEO in 5 years has not bought a single share from what I could tell, which is a bit concerning for me when she's last year earned $4 million US. So to me, there's a few red flags there that I'm just waiting to clear out a little bit. I think it's a great company, and if I press the wrong button and accidentally bought a load of it tomorrow, I wouldn't be upset. But I just think maybe it's got another couple of months to go one way or the other, either go down a bit more or to prove itself and start going back up again. So that's my current thesis on Diageo.
I appreciate that. And I know we're just going to be repeating ourselves from when the last time we covered Diageo was. But do you not kind of think as well, though, it's like it's such a fantastic company, such fantastic brands. I mean, it is just of a side where in reality, you know, the CEO will probably have some pretty decent stock options. They might be like a professional CEO that's not, I don't know, you just can't really necessarily expect them to be pumping all the money into Diageo. I just think, you know, you're talking about how you followed it since 2017, like you wish you'd had a chance to get it. And the problem is as well, it's such a great company that I just think, yeah, if it does, if you've got X, Y, and Z concerns and it starts to prove the doubters wrong in the next few months, it's going to be back at sort of 20 to 25 PE ratio again in no time. I appreciate what you're saying, but then that is the risk you're taking to get it at the price, a 7-year low.
Yeah.
And if it's been on your watch list that long, is there not an element of, well, maybe you should just take a nibble because you might not get this opportunity again for 5 years?
Yeah. I think you're right. I think I'm definitely playing hard to get a bit with this one. I wouldn't surprise me if by the end of the week or the end of the month it has started to go into my portfolio. Just looking at the chart, it did close above the 50-day moving average Thursday, but then drop back down on Friday. I'm probably aiming for perfection with my timing, which we all know is totally impossible. So it is probably one I'll put a starter position in the next few weeks and potentially scale up from there if it does go in the right direction.
I think it was actually South America. Was
It
it South
was,
America
yeah.
and Caribbean?
Yeah, Latin and Central America, something like that.
Yeah, which ironically is obviously where you saw the man with the tattoo. But you know, those markets are just, you know, they're higher margin, and if they drop off, that's, you know, because they are poorer countries. If I don't know what their economies are like, but if their economies are struggling or whatever, they are going to drop off disproportionately, and that is going to knock on to profits. But yeah, this might be the start of, I don't know, a 2 or 3 year trend. But even still, I struggle to see a scenario where in 10 years' time, unless this is the start of something that's really, really concerning, which I don't think it is, I struggle to see a scenario in 10 years' time where it's like, oh, I wish I hadn't bought then, even if you maybe get the chance to add even lower in another 6 to 12 months. But the thing is with Diageo, companies like Diageo, it's like, apart from COVID, I can't think of a time, in the whole time that I've been following the stock where it's been as cheap as this.
Yeah. I mean, to be honest, during COVID, look at the chart here, it went to £23.5 a share. It's at £24.5 now, so it's almost at its COVID lows,
Well,
really.
it has been lower, hasn't it? It's 52-week lows, 22.75.
Yeah, it has been a bit lower. Yeah, so you can pick up now. And I think again, we talked about it in the last podcast with British American Tobacco about how there's a lot of people calling the end of tobacco and the end of drinking because young people aren't drinking as much. But history, you go back a few millennia, you go back to the pyramids and people were fermenting wine and beer back then. I don't think this is a long-term global trend that young people will stop drinking. In fact, I think it might be that people stop drinking cheap lager on nights out and maybe have a nicer spirit. And maybe that's the secular change that's going to happen. So, yeah, I do like Diageo. It's one of those ones that when I buy it, I'll get a chunk of it in my sip and just leave it there for 10 or 20 years probably. So I think it's a great company and it's fairly unique really in the UK stock market in terms of the quality of the brands it's got.
We talk about JD Sports, which you said is the other one that you've been thinking about it. And so again, this is one that we have covered for a while on the show. And the concern I have is that when you go into a JD Sports in the UK, it is quite a cool place. And I think we talked about this last year. It's like, teenagers will go almost to like hang out, which is really, really rare.
Yeah.
But then you've got those foreign acquisitions. And I don't know, in the US, do teenagers hang out in Shoe Palace? I don't know. They might be excellent businesses, but that's what I struggle with. Has the quality of that brand been diluted?
Yeah, I'm not too sure I can answer that one. I didn't spend a lot of my time in the US in sports stores, so maybe people don't go and hang out in them. I think one thing that I didn't really know about JD until I started researching it about 2 or 3 months ago was the range of brands that they have. And by that, I mean, in the UK, it's predominantly branded JD Sports, but in Europe, they have a whole range of other brands. So you walk down the high street, will not necessarily see JD Sports, but you will see AN other brands that's out there. So I think from memory in the UK, they've got about 500 or 600 stores, but actually globally, they've got about 3,500 stores. So I think the coolness of JD Sports isn't necessarily the be all and end all. I think they're quite good at branding. When you go into their stores, they are really cool. They look really good. They look so much better than a lot of other stores on the high street. And I don't think their plan in the US with Hibbett Sports, who they've bought 1,000 stores from, I don't think their plan is necessarily to turn them all into JD Sports. I think their plan is maybe to take some of the design cues that they've learned work in the UK and maybe apply them to the US side of the business. I think one thing that JD got caught up in a year or two ago was the fear that Nike and Adidas were kind of coming for their lunch. And by that, I mean, there was a real fear that Nike would be selling direct to consumers with special editions and Adidas would be doing the same, and it would kind of leave JD Sports redundant. And I think two things have kind of changed over the last couple of years, which maybe mean that's not so much a risk anymore. First of all, you've had Nike have had a pretty torrid year or so. Their share price is well down and they're really trying to refocus the business and work out what they're all about. And the same with Adidas with Yeezys and whatnot. There's been a lot of controversy around Kanye West there. And they're having to do a bit of thinking about where their future is going to be. I can't remember what the figure was now, but I heard the percentage of profits that Kanye West line provided to Adidas, and it was astronomical. So I think these companies are probably now in a weaker position than they were before. On the flip side, JD have just acquired 1,000 new stores, so they're up to now nearly 4,500 worldwide. And I wonder whether these brands are really going to want to annoy what must be one of, if not their very biggest customer. The other thing with JD, looking at their range of products, they have a lot of these new upstart companies that have been called out as being the brands that are causing Nike trouble. So Hoka, who do mostly running shoes, and On Running, you can get both of those in JD Sports. Whilst that's been a huge strategic misfooting almost for Nike, if you'll excuse the pun, these brands are in JD Sports already. So if you want a pair of Hoka instead of a pair of Nike, you can just go into JD and buy them. And I'm sure the next upstart brand that comes along that's the next big thing, I'm sure JD Sports will have it. And I did look at buying Nike. just because I think it's such a unique brand in terms of the fact you've got super cool 12, 13-year-old kids wearing Nike, and you've also got like 80-year-old grandpas on the golf course wearing Nike. It's such a unique brand. But then I kind of think you could just buy a retailer like JD and have exposure to lots of different brands. Also on JD, one of the directors or a couple of them have bought 200 grand's worth of stock this year. So you do have a few signs that the directors are optimistic about where it's going. Yeah, I just think it's a really interesting business, and I am very guilty for underestimating JD the first few times I heard about the company. But when you actually do a bit of digging, it's quite an interesting firm.
So you mentioned that you looked at Nike. What was the logic for not buying it? So I mean, I guess with me, it's my concern would be it's one that we followed on the show. We both love the brand, and I think it's one that at the right price we'd both love to own. But even though it, like you say, has had a horrible last sort of 12, 18 months, I know it's cheap compared to where it was, but if it traded in Europe, I don't think it would. I think it'd be a lot cheaper,
Yeah.
essentially. And it's just, but then when you look at Adidas, which we probably haven't covered for like a couple of years now, but that's actually doing quite well compared to the last time we covered it. So yeah, so what's the logic? Did you look at buying either of those? And then also, I guess a follow-on point is, does it not concern you that even if the direct consumers maybe in pause because they might not want to annoy JD that much until they've sorted themselves out, in the long term, that surely has to be their ambition?
Yeah, I think it does. I've just pulled out the Nike price earnings. It looks like they're at about 20 to 25, depending on which figures you use on Google, and JD are at 8.5. So there's a huge disparity in the valuation between them, except they're totally different business models, but that's still a big difference. I think I really like Nike. I think part of it came from recently I ran the Manchester Marathon, and it was interesting standing on the start line, noting just how few people were wearing Nike products. I run in Hoka's. Almost everyone on the start line was wearing Hoka's. There are very few on running, to be honest. They seem to be more fashion than serious running shoe. Quite a lot of Asics, few New Balances here and there, but Nike seem to have kind of split the market a little bit. So your guys that are running 2 hour 10 marathon will generally be in the Nike next gen 2%, I think it's called, which is their 250, 300 quid pair of running shoes. Your average runner generally won't wear Nike on the whole, but then your kids on the street will pay 60, 70, 80 quid for a pair of Air Force Ones. It seems like Nike are doing really well at the ultra premium high-end athletes. I'm quite certain if you look at the finishing line in the Olympics, a lot of those guys are wearing Nikes, and they seem to be quite good on the fashion side, but they seem to have lost that middle ground a little bit. And that concerns me a little bit, that Nike for 20, 30 years has been the go-to name for almost every sport on the face of the planet. That's the other interesting with them. They aren't sport specific. They're not just running. They're not just golf. You know, you go to any sports city and people would be wearing Nike. But it does concern me a little bit. And also, I don't like buying share price while it's going down. I definitely want to see it leveling off or going up before I buy. And certainly when I looked at Nike, it was on quite a high PE still, with the share price going down. And just a few concerns about what direction it was taking from here just spooked me a bit.
Have you ever looked at Adidas then?
No, I haven't, to be perfectly honest. It's one of those brands I'm not really as familiar with as Nike. It's definitely much bigger in Germany than it is in the UK. So no, I haven't taken any serious time to look at it. Obviously listen to you guys doing your analysis on it, but it's not one that leaps out to me in the same way that Nike does necessarily.
Because I think when we last sort of looked at it, I think it was about a fifth of the Nike market cap. And I think because of what's happened with Nike and Adidas, it's now come down to about a third. But the thing is, it's just like after the Yeezy thing, it's a business I'd really like, especially because I think I can't remember his surname, but James came on Quality Compound.
Uh-huh.
He had it, and that was one of the things he highlighted. You know, you think Nike and Adidas, and you almost think of them, you probably think of them as fairly similar sized businesses, and then you don't expect one to have a market cap 5 times the size of the other, and it does sort of catch your attention. But then when you look at, I suppose it did drop a bit, but it dropped from Adidas was at a high of in 2021 of €311, and it did go all the way down to like €100. But then it's since gone up to like 220. And I think the problem is it was like you had even after the Yeezy thing, and I think it was having quite poor results then as well, but the Yeezy scandal really, you had such a narrow window to buy. And
Yeah.
if you were slightly concerned about anything and held off, it was kind of like you almost missed your chance. And it might be that now the valuation's still fairly reasonable, but we haven't looked at it since. And I think an issue I have is psychologically, having missed that window, I don't know if I want to pay double the price. But it's a business I
Yeah.
would like to own, but I don't look at it enough to really actually know. It's like I say, it's been like 2 years since we covered it on the show, and I haven't looked at it like privately or anything either.
No, I haven't. I've just pulled up the share price for it, but you're absolutely right. It's done very well. Nike looks like it was kind of at 5-year lows a week or so ago, down around like $72. It looks like it's picked up a little bit in the last week or so. I don't know what's
But
happened
I
there,
just
but
think with Nike though as well, it's like I know it's come down a lot, but it's come down from a P of like 40 to what did you say, 2022?
yeah, 22
But
it says on Google.
I mean, even at 22, do I see Nike growing 10% a year?
Yeah, it's
I
probably
don't know
not
if I
going to
even
happen.
do. It's just so saturated. So then it's like, what you expecting me? Like, what would be good for Nike, given how saturated it is? Probably mid-single digits would probably be pretty
Yeah.
good if they could hit that for the next sort of 5 years. And you look, how many years of mid-single digit growth do you need even to justify a 22 PE? It's quite a lot, I think. And I know brands like that do usually trade at a premium anyway, but I just wouldn't be comfortable paying 22 times earnings for a business that I think in a best case scenario might grow at 6% a year.
Yeah, I think you're right. I think there is an element of investors, myself included, kind of wanting to collect these blue chip companies and have a small stake of them in their portfolio. Nike definitely falls into that camp, and maybe to a degree Diageo does, in that it's just such a well-known name. It's such a good business. Everyone wants to own a little bit of it, and it's almost like waiting for when the price and when the time's right, rather than analyzing whether the business is actually still a good fit with your portfolio. I think you're absolutely right that like Nike is not going to be growing at huge volumes going forward from here, but you're paying quite a high valuation. And if you blindfolded me and I didn't know that the share was Nike, would I be looking at this company with a 22 PE and saying, yeah, that's a good investment? I probably wouldn't. I'd probably be putting more money into Supreme or Supermarket REIT or some of the other holdings like ABF, Associated British Foods, because I think it's growing quicker and it's cheaper. So yeah, I think you're absolutely right on that one, that
I think
it
with
maybe has
Nike,
got
it's
a bit
like
further to come.
it is a business I'd love to own it. If I think about sort of UK businesses in that kind of industry, accepting there's maybe a premium because of the quality of the brand, it's like what could you actually pay and expect to get a reasonable return? Not even
Yeah.
market beating, just sort of like an average return. And I think for me, like the figure I'd have in my head, it would be like I wouldn't really want to go above sort of 15, 16 times earnings. And that's just a made up number, but it's for me, it's if as good as the brand is, if it's only going to grow 5% a year, it is still an investment first. And if I want to collect it, I'll go out and buy a pair. That would be
Yes.
my mentality with it.
Yeah, it's true. And I was listening to the Investors Chronicle podcast earlier, which is very good. And they were talking about Google, which is currently on a price earnings of 19. So I would say Google's fairly saturated in the West, but there's still a lot of potential there in terms of AI and growing into developing markets. I'd certainly rather have Google at 19 than Nike at 22 at the minute.
I would as well. What's the Investors Chronicle podcast like now? Because I used to listen to it a few years ago, and obviously that was when it was Phil Oakley
That's right.
and the
John
other guy.
Human.
Yeah, and then they obviously left and did their own thing, and then it sort of, I think I stuck with it for like maybe a year afterwards, and they started sort of. I know you're more into it, but they started bringing on traders and stuff, and it didn't really feel like there was that same sort of quality analysis that you used to get from Phil Oakley. So what has it
Yes.
changed at all?
Yeah, it has. It's more of a panel discussion now. So they tend to have one main presenter and a second presenter joining him or her. And then they'll have two, maybe three of the journalists from the magazine generally talking about what they've written on this week. So it's quite a nice mix. You normally get a couple of companies, a bit of macro stuff. It's also the quality of the recordings improved a lot. It's a bit more humorous than it was. It's definitely easier to listen to than it maybe was back in the day. Yeah, if you haven't listened to it in a while, I definitely recommend checking out. It's only
Okay,
45 minutes or so a week, but it is very good.
yeah. Well, I used to listen every week, and I did stick with it for a while after Phil Oakley and Johnny Human left. But I gave it maybe a year, and I just thought, well, there's just better uses of my time was the
Yeah,
conclusion I
yeah.
came to. But I might have to put it back on. I think that's everything from me, unless there's anything you'd like to discuss before we wrap up.
No, I'd just like to say a big thank you for having me back on. It was a great experience on last time. Some of the questions you asked me definitely stayed in my mind for a few weeks and definitely swayed some of my decisions going forward in terms of cleaning up my portfolio. So I can only thank you for the experience and the conversations we had back then. If there's
Fine. I'm
anyone
happy to take
listening,
responsibility if the portfolio has gone up.
if there's anyone listening who's in two minds about coming on, absolutely do it. It's a brilliant experience. Can't recommend it enough.
I may as well do a little plug for it. But in the last it's a poor excuse, but probably in the last 12 months, I've been living somewhere with unbelievably unreliable Wi-Fi. And the problem is I've been renting and I've not had control over the internet provider. So the issue I've had is I've not wanted to arrange interviews because I don't want to arrange an interview where it might, the internet might cut out. And it's like when I'm recording with John every week, no disrespect to John, but I don't mind the internet cutting out with John. But like, we might have it once a month, but at some point my internet drops down, and I just don't want that, with a guest.
I get that.
So I am moving in sort of the next few weeks, and I will, shortly after this has aired, actually, because this will probably air sort of mid-September time. So in terms of interviews, it is something I would like to get back into, and we will be kind of open for business again. So if anyone does want to come on for an interview, we would be very happy to have you. It doesn't really matter kind of where you are as an investor either. I'd say if you've been doing it for 40 years or you started a year ago, I think it's wherever you are in your journey, it's always very relatable for someone who's listening. And as long as you've got companies that you're interested in and you can talk about for kind of 5 minutes, there's not a huge bar you have to clear. We're not expecting someone to have sort of Buffett level of returns. It's more if you're interested and you've got some ideas that you think other people might be interested in, please do message us on Twitter, or X as it's now known, at TIW Tweets, and we'd be very happy to have you on for a chat. So with that, thank you very, very much for coming back on. And where can people go if they want to find out more about you, or find your threads that you've referred to? So I have just retweeted the one that you talked about the REITs.
Oh, cool.
From the TIW tweets. Now, by the time this goes out, it will have been a month ago. But if we don't tweet a huge amount on the podcast, on the Twitter for the podcast. So if you do scroll down, you'll find it probably a bit quicker than if you scroll down on your feed. But so where can people go to find out more about you?
Yeah, so I'm on Twitter as Flying Finance, all one word. If there's anything I've mentioned on the show that you want any more information on, please feel free to just drop me a message. I'm always there. I'm always happy to help and respond to these things. I don't tweet all that much. I'm not one of these people who's up at 7 a.m. every morning tweeting stuff. I'm generally either at work at 4 or 5 in the morning, or I'm fast asleep recovering from the previous day's work. So I don't tweet all that often, but every now and then I just pop up a thread with a few things that have caught my eye that might be of interest to you. So yeah, follow me on Twitter and drop me a line if there's anything anyone listening wants in particular.
Right. Well, thank you very much again for coming on, and thank you everyone for listening, and we'll see you all next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIW Tweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.